In this video, we are going to look at some of the accounting and business processes. We'll examine the data to see if there is anything that's abnormal. So in this case, we're going to look at the sales invoice table again, and we will go analyze the data. One of the things we can analyze, for example, is the aging report, AR aging report. First of all, we're going to do the cutoff date to be in 2005 because the data is all in 2004. So we will do this to be, for example, most of the data lies between January 1st, 2004 and until about mid-January 2005. So the cutoff date will be for us 2005 end of January. And we will look at the amount due. We will also limit all the transactions to be the due date is greater than, and then we will click on date here to select the date, and we will put 2003 because we want the end of December 2003. So anything above that, which will start January 1st, 2004, the due date is greater than the end of December 2003. And then we'll put an and. Again, the due date is smaller than, and then we'll click date again to select, and we will put 2004 here, but we will select 2005 January 31st. So what we are saying here is, let us look at the aging report for all the transactions that somewhere between January 1st, 2004 and January 31st, 2005 do some totals, the totals of 0, 30 days, 60 days, 90 days, 120, and then from 120 to 10,000 days. And when we press OK, we get an aging report that tells us how is the company doing in 2004. Well, there is a total of over $5 million outstanding in AR. Only 324,000.7 are within 30 days. We find that there is 1.75 million between 30 and 60, 1 million between 60 and 90, a small amount 173,000 between 90 and 120, and then more than 120 days, over $2 million. That's clearly a problem. 31% of the invoices are not being followed up after 120 days and between 30 and 60. If we want to see this in a graph, we go to the bottom here and we click graph, and that shows the same data in a graphical format. So clearly this company has a problem in terms of collection, and that will affect the company performance, cash flow, and so on. If we go to customer and invoices, we can do another test. We go to analyze again, and we do cross tabulate. In this case, let's cross tabulate the state with sales rep. Every sales rep should have only one state as a territory. So when we do this analysis, we'll look at it and see in Alabama there is one salesperson. We can go across and we can see that there is no other. And as a result, for every state we should see one salesperson, and we hope to see just a diagonal line that has numbers. Everything else is zeros. So if we go down and to the right, everything happens this way. The rest are all zeros. So we don't have crossover between salespeople selling in each other territory. So between the aging report we looked at and between the sales territory versus salesperson cross tabulation program analysis, we can see that the company is bad in money collection, but it is good in terms of salespeople limiting their sales to their own territory.